What if the most dangerous weapon pointed at America right now isn't a missile? It's a bank account. Because quietly, behind closed doors in Europe's most powerful financial capitals, serious people are discussing something that has never been discussed before. Nearly $10 trillion. And for the first time in history, the question being asked is simple, and honestly, pretty terrifying. What happens if Europe stops paying America's bills? The spark. There's a particular kind of confidence, some might call it arrogance, that only the world's most powerful leader can get away with. The kind where you look at a sovereign Arctic island belonging to a close ally, one that has its own people, its own government, its own flag, and say publicly, with cameras rolling, "We want that." That's what Donald Trump did with Greenland. Most people laughed it off at first. Political theater, a distraction. The kind of headline that burns bright for 48 hours and then disappears. But Trump didn't walk it back. He escalated. His administration followed that declaration with a direct economic threat to European nations, a sweeping 10% tariff on their exports to the United States if they dared to resist his push. February 1st was set as the deadline. And just like that, what looked like a geopolitical stunt became a financial crisis in slow motion. Because Europe didn't fold. Instead, it started asking a question that no American ally has ever seriously asked before. What if we used our money as a weapon? The number that changes everything. Here's where this story gets genuinely jaw-dropping. Analysts who track global capital flows, people who spend their entire careers watching where money moves and why, have put a number on Europe's exposure to American financial markets. And that number is staggering, close to $10 trillion. That's the combined value of U.S. Treasury bonds, American stocks, and long-term securities held within the European Union, the United Kingdom, and Norway. $10 trillion. That's larger than the entire GDP of Africa. It's more than double what Germany, Europe's biggest economy, produces in an entire year. But here's what makes that number truly significant. These aren't passive investments sitting in a vault somewhere. They are the financial engine that keeps America running. The United States runs enormous budget deficits. It borrows continuously, spending far more than it collects in taxes, financing everything from its military budget to its social programs to its national infrastructure. And it can do all of that without triggering a debt crisis for one reason. The rest of the world keeps buying American bonds, keeps trusting the dollar, keeps treating American assets as the gold standard of global finance. Europe is not just a participant in that system. European investors, pension funds, insurance companies, asset managers hold roughly 40% of all foreign-owned U.S. Treasury bonds. 40%. That makes Europe, collectively, one of the single most important financial lifelines keeping Washington solvent and the dollar dominant. Now consider what it means that serious people in Europe are starting to ask whether that lifeline should continue when the serious money starts talking. In financial markets, the moment you know something has shifted from theoretical to real is when the serious institutions start discussing it openly. Fringe voices talk about tail risks all the time, but when a name like Deutsche Bank puts it in writing, you listen. George Saravelos, Deutsche Bank's chief global currency strategist, introduced a phrase that has since been echoing through trading rooms and policy offices across the world. He called it the weaponization of capital. His argument wasn't emotional, it wasn't political, it was purely structural, and that's what made it so powerful. America, for all its military dominance and technological might, has one critical financial vulnerability. It relies on the confidence of foreign investors to fund its deficits. It borrows from the world, and the world, Europe in particular, has been lending willingly for decades, not just because the returns were good, but because the alliance was working. Because there was a shared understanding of mutual benefit and mutual respect. Saravelos asked the obvious question that nobody in Washington seemed to be asking. If America is now using economic coercion against the very allies who finance its debt, why would those allies keep financing it? That's not a revolutionary statement. That's just logic. Why Europe probably won't pull the trigger yet. Now, before alarm bells start ringing too loudly, there's an important piece of this story that deserves equal attention. Most strategists still believe Europe won't actually do it, at least not deliberately, at least not at scale. The reason is straightforward. Selling U.S. assets doesn't just hurt America, it hurts the seller. The bulk of Europe's exposure to American markets isn't controlled by politicians. It sits inside private pension funds, the retirement savings of ordinary workers across France, Germany, the Netherlands, Sweden, and beyond. Insurance portfolios. Institutional asset managers who have legal obligations to protect the people whose money they manage. No French finance minister can call up a pension fund and order it to dump its American holdings and absorb the losses for geopolitical reasons. The moment European governments tried to weaponize private savings, their own voters would pay the price. That's not a trade any elected government takes easily. Société Générale's Kit Jukas has spelled this out clearly. America's enormous investment deficit only becomes a genuine vulnerability for the dollar if foreign holders are willing to suffer losses themselves to inflict damage. And markets, by their nature, don't usually operate on deliberate self-sacrifice. But, and this is a crucial but, the real risk isn't a single dramatic decision made in a Brussels boardroom. The real risk is millions of individual investors, each making perfectly rational, self-interested choices, quietly deciding that American assets deserve a higher risk premium than they used to. No order needed, no political coordination required, just updated spreadsheets and rebalanced portfolios, repeated across thousands of institutions simultaneously. That kind of slow, distributed shift can be just as damaging as a coordinated attack, and it's far harder to stop. While the financial threat remains at the discussion stage, Europe's political response is already moving faster than most people realize. Buried deep inside the European Union's legal framework is a mechanism that most people have never heard of. It's called the Anti-Coercion Instrument, and it was designed for exactly this kind of situation, when a foreign power uses economic pressure as political blackmail. The ACI isn't symbolic. It has real teeth. Activating it allows the EU to impose targeted tariffs on specific American sectors, freeze pending trade deals, restrict investment flows, and coordinate a unified retaliatory posture across all 27 member states. According to people with direct knowledge of discussions inside the Élysée Palace, President Emmanuel Macron has been pushing France to formally request its activation. If that happens, we're talking about tariffs on tens of billions of dollars worth of American goods, agriculture, automotive parts, technology, consumer products, carefully targeted to inflict maximum political pain inside the United States. And here's the irony that Washington appears to have missed entirely. Trump's tariff threats were presumably designed to split Europe, to make individual countries calculate that the cost of resistance was higher than the cost of compliance. Instead, the pressure appears to be producing the opposite effect, pushing European governments toward a level of coordinated action that the bloc has struggled to achieve for years. Pressure doesn't always produce surrender. Sometimes it builds coalitions. Markets have a way of telling the truth before politicians do. And the signals coming from global markets throughout this period of escalating tension have been consistent and clear. U.S. equity futures have repeatedly come under pressure at moments of peak transatlantic friction. The dollar has weakened. And safe haven assets, the instruments investors flee toward when they sense real systemic risk, have surged. Gold climbed. The Swiss franc strengthened. Even the euro has seen renewed demand. These movements are echoes of something that happened last April, when Trump's Liberation Day tariff announcement sent genuine shockwaves through global capital markets. Treasury yields spiked. 30-year yields jumped more than 80 basis points in just a few weeks. The dollar fell more than 8% over the course of 2025, its worst annual performance since 2017. U.S. stocks underperformed global peers by margins that would have seemed implausible at the start of the year. Many investors reassured themselves that it was temporary, a panic, a buying opportunity, the kind of volatility that resolves once the political noise fades. Now, with the same dynamics reasserting themselves, a growing number of portfolio managers are no longer so sure. What if last year wasn't a panic? What if it was a preview? And then, as if the Greenland standoff and the tariff threats weren't already rattling enough nerves, another crack appeared. Trump's long-running battle with the Federal Reserve escalated sharply in early 2025. After months of public attacks on Fed Chair Jerome Powell, calling him too slow, too political, too resistant to cutting interest rates, news broke that sent a very different kind of chill through global markets. The Federal Reserve had been served grand jury subpoenas connected to Powell's congressional testimony. For global investors, the legal specifics were almost beside the point. What mattered was the signal. The Federal Reserve's independence, its ability to make monetary policy decisions based on economic evidence rather than political instruction, is not just an American institutional principle. It is a cornerstone of global confidence in the dollar, in U.S. Treasury bonds, and in American financial markets broadly. The moment that independence comes into question, even just as a perception, every assumption investors make about the reliability of U.S. monetary policy shifts. Interest rates, inflation management, currency stability, all of it rests on the belief that the Fed is not a political instrument. Portfolio managers issued the same warning in different words. Any development that raises doubt about Fed autonomy increases the risk attached to U.S. assets and accelerates the argument for diversification. Gold surged again, not by coincidence, as a verdict. When financial analysts give something a name, when a pattern gets a label that traders use consistently, it means the phenomenon has moved from isolated event to recognized trend. The Sell America trade earned its name last year during the Liberation Day shock. It described something that broke a fundamental rule of market behavior. Investors simultaneously selling U.S. Treasuries, U.S. equities, and the dollar, all at once. Under normal conditions, when stocks fall, bonds rise as investors seek safety. When the dollar weakens, treasuries often hold. Different asset classes buffer each other. The Sell America trade dissolved those buffers. Everything American declined together. That's not a panic. That's a structural reassessment. And now it's happening again. Not yet at full force. But the same fingerprints, dollar softness, equity pressure, yield volatility, safe haven demand, are reappearing as the transatlantic tensions escalate and doubts about the Fed circulate through the market. The optimists aren't wrong that American fundamentals remain strong. The AI boom is real. U.S. productivity is genuine. The dollar's reserve status doesn't disappear overnight. But even the cautious voices are acknowledging something important. The risk this time isn't coming from outside. It's being manufactured inside Washington, by the same government that is supposed to be the steward of the world's reserve currency. That's a different kind of problem. And markets know it. Capital flows towards stability. It doesn't follow flags. It follows confidence. And as American predictability has declined, money has started moving. One of the clearest expressions of this shift has been Canada's remarkable stock market performance. The S&P/TSX Composite, Canada's benchmark equity index, surged 28% last year. Impressive on its own. But measured against the S&P 500's 16% gain in the same period, it becomes extraordinary. Canadian stocks outperformed American stocks by 12 percentage points, the widest gap in roughly 20 years. Money managers who have spent careers overweighting U.S. equities are now openly building positions in Canadian markets. Not because Canada has suddenly become more innovative or dynamic, but because political predictability, institutional stability, and freedom from trade war uncertainty have genuine financial value. And right now, Canada is offering more of all three than its neighbor. The same logic is driving fresh capital into gold miners, European defense stocks, and even select emerging markets that previously would never have been mentioned in the same sentence as safe haven. The appeal isn't that these alternatives are superior. It's that they're becoming relatively less risky as American unpredictability rises. That's the quiet financial verdict being written in real time. Beneath all the market data and the policy debates and the geopolitical maneuvering, there's a deeper question that this entire situation is forcing into view. What is an alliance actually worth? The Western alliance wasn't built on sentiment. It was built on shared interest. America got cheap financing for its deficits, military basing rights, political legitimacy, and access to allied markets. Europe got security guarantees, access to American markets, and the protection of a rules-based international order that allowed devastated post-war economies to rebuild into thriving democracies. For 75 years, that bargain held, not without friction, but fundamentally intact. Because both sides understood that the costs of breaking it were always higher than the costs of maintaining it. What the current period is testing is whether that calculation still holds, whether Washington truly understands, in financial terms not just rhetorical ones, what allied goodwill is worth, whether the short-term gains from pressuring allies outweigh the long-term costs of eroding the trust that makes those allies financially indispensable. Sarah Vellos at Deutsche Bank put it plainly. If America is using economic coercion against the countries whose capital underpins its ability to run deficits, why should those countries continue to subsidize the arrangement? It's not a hostile question. It's a rational one. And the fact that it's being asked at all, openly by respected analysts at major financial institutions, tells you how much the landscape has already shifted. Here's what this all comes down to. Europe has not dumped its American assets. The $10 trillion hasn't moved, at least not dramatically. The dollar is still the world's reserve currency. U.S. Treasuries are still the benchmark safe haven. The alliance hasn't formally broken, but something invisible has changed. A threshold has been crossed, not in markets, not yet in policy, but in imagination. The idea that was once too absurd to take seriously is now being modeled, analyzed, and published by the world's most respected financial institutions. The idea that Europe might one day stop financing America. Not out of hostility, not to destroy the alliance, but because when you push reliable partners far enough, eventually even the most patient ally asks the oldest question in any relationship. Is this still worth it? That question, once it's been asked, doesn't disappear when the immediate crisis fades. It lingers, it recalibrates, it shifts behavior at the margins. And when you're the world's largest debtor, depending on allied goodwill to fund your future, the cost of making that question feel necessary is one you cannot afford to keep paying. America didn't lose Europe's confidence overnight, but it is losing it, gradually, quietly, one updated risk model at a time. And that may prove to be the most expensive thing this political moment ever produced. That's the story as it stands today, not a prediction, not a political opinion, just the facts, followed wherever they lead. If this kind of journalism matters to you, the kind that goes past the headlines, past the noise, and straight to the forces quietly reshaping the world, then you already know the one thing that keeps work like this alive. Your support. Subscribe if you haven't. Share this with someone who needs to see it. And leave your thoughts below. Because the real conversation happens in the comments, not the script. Stay curious, stay informed, and never stop asking why.